are at least 4 year-end tax planning strategies that you can use to lower your 2022 tax bill. And here to talk with me about this is Philip Herzberg from Team Hewins. Philip, welcome.
Hi, Bob. Thanks for having me again, sharing insights.
It's a pleasure to have you here, Philip. And we're eager to have you walk us through these tax planning strategies that can help our readers and viewers lower their tax bill.
Well, if you're feeling deflated by the past several months of soaring inflation, investment market losses, and interest rate hikes, there's still time to save money on taxes with year-end planning strategies. And here are 4 proactive planning moves that may help you lower your 2022 tax bill. First, may want to consider a Roth IRA conversion. Second, think about bunching charitable gifts with a donor-advised fund. Third, consider saving tax money, with charitable donations from your IRA. And fourth and finally, you may want to withhold taxes from year-end IRA required minimum distributions.
Great. So let's do a deeper dive on the first of these 4, the Roth IRA conversion. Tell us more about how that would work.
Yeah, so quite simply, the recent stock and bond market decline has made the Roth IRA conversion more appealing for those who are well positioned to take advantage of this strategy in a historically low tax rate environment. And here are 2 reasons why. First, a market downturn permits investors to convert a larger portion of their IRA and enjoy tax-free growth, as well as possible tax-free distributions in the future inside the Roth IRA with the eventual stock market recovery. And second Roth conversion incentive is a lower tax bill, as the liability for a conversion will be cheaper now than it had been when the markets were higher. So you're going to want to assess how the extra income from the Roth IRA conversion may affect your taxes. And just note there are possible unintended consequences that come with these Roth conversions, such as a hike in Medicare premiums and possible increases in ordinary income tax bracket and capital gains tax rate. So important to seek the guidance of a qualified tax and certified financial planner professional to evaluate whether a Roth conversion is beneficial for your overall financial situation. If you're considering some or all of your traditional IRA into a Roth IRA, converting those funds, the conversion funds must be out of the pre-tax IRA by December 31st, 2022.
Right. And I think it's important to note that many custodians these days are encouraging clients to do this even sooner than year end, right? As soon as mid-November or early December.
Absolutely, because there's no guarantees that processing will be done in a timely manner. So you'll want to act on this sooner rather than later. Another important caveat here is to just make sure you have the money that's available to pay the taxes on that are due when you make that Roth IRA conversion.
Right. So tell us more about bunching charitable gifts with a donor advised fund.
Yeah, and still, despite economic concerns, there's a strong desire in the world to make charitable gifts. And after the standard deduction doubled under the 2017 Tax Cut and Jobs Act law, more taxpayers started losing out on the same level of tax benefits they previously secured with their year-end giving. Charitable gift bundling can help you get over this standard deduction hurdle. A year-end gift to an established donor advised fund enables you to front load multiple years worth of support for important causes and organizations that you intend to support in the years to come. And by doing so, you get that upfront tax deduction this year and lock in long-term support for one or more nonprofit charitable organizations with causes that are near and dear to your heart. So after guaranteeing that tax deduction now, you can take your time distributing support and have that flexibility to be able to choose how you want to distribute those funds through your donor advised funds.
Right. And there's a good way, a tax effective way to contribute to a DAF.
Absolutely. And the most tax effective way to fund a donor advised fund is by contributing highly appreciated stock, which is a win-win in 2 ways for philanthropic giving. First, you're giving the upfront tax deduction for the value of the securities you donate. Second, you are also removing the tax liability associated with the appreciation of that stock. So, so the upshot is all the appreciation is basically wiped away, and the capital gains disappear. So there's a greater benefit to charitably donating profitable securities than you would otherwise get with cash, as you would dodge capital gains taxes you otherwise would owe when selling the assets in the investment account to fund the donation. And essentially, the donor advised fund is like a charitable checking account, which allows a bigger upfront deduction and the ability to make future gifts to charities over time.
Right. So speaking of charities, folks can also save tax money with charitable donations from their IRAs.
Yeah, and many still don't know about this. So if you're philanthropically inclined and are not able to annually itemize deductions, you can utilize what's called qualified charitable distributions, or what's called QCDs, to directly transfer cash to qualified charities from their IRAs. And this is a real impactful way or strategy to save money on taxes. So if you're age 70 and a half or older, you may use QCDs to directly donate up to $100,000 every year. And for those of you who are 72 or older, a significant positive of utilizing this qualified charitable distribution strategy is that you can satisfy your IRA required minimum distribution by individually donating up to $100,000 of the required minimum distribution, your RMD, to charity from an IRA, paying no tax on what would have been a distribution taxed as ordinary income.
So, and people can't double dip on this. I think you mentioned that in the article.
Absolutely not. You cannot obtain a double tax break by taking a QCD and receiving an itemized deduction for a charitable gift. So rather than counting as an itemized deduction, QCDs for those taking required minimum distributions may lower your adjusted gross income, which can possibly help you avoid Medicare premium increases and boost your tax savings. I'll walk you through an example of how a QCD would work for a 72-year-old working individual taking RMDs from a former employer's IRA and unable to itemize deductions on the personal tax return. So this single or married filing jointly filer who falls in the 35% federal marginal tax rate could directly make a 10,000 qualified charitable distribution in cash, and the gift would result in huge tax savings of $3,500 with just 10,000 transferred from the IRA to the qualified charity. So this money, this 10,000 would be excluded from the required minimum distributions taxable income. Plus, this working individual gets a charitable tax benefit that otherwise would not have been received had this donation been made from a personal checking account.
So tell us about the fourth strategy, withholding taxes from year-end IRA RMDs.
Yep, and Bob, one of the things it's important about this fourth strategy for some retirees who have not made quarterly estimated tax payments in 2022, there's still some time to avoid later penalties. So retirees generally need to send tax payments 4 times a year if they're not withholding enough from self-employment income, investments, Social Security, pension, or other guaranteed income sources. And there's an opportunity for the retirees to avoid penalties for missed payments by withholding taxes from year-end required minimum distributions from the IRA. So for example, if you need to withdraw $50,000 from the IRA by year end to fulfill your 2022 required minimum distribution, you can estimate the year's total federal and state tax liability without the funds from your RMD. So if you gauged you still owed $4,000 in taxes to meet these quarterly estimated tax obligations, you could choose to withhold that amount, send it to the IRS, and receive the remaining $46,000 withdrawal. So notably, if you complete this withholding by December 31st, it's considered prorated for each quarter, meaning it counts as an on-time payment made by each deadline. So be sure to consult your qualified tax professional in tandem with your trusted certified financial planner professional to figure how much you'll need to withhold from your IRA required minimum distribution to avoid these late penalties.
Right. So, Philip, I know we talk about these as year-end tax planning strategies, but the real important thing is that you're doing tax planning throughout the year. Just talk about that for a second.
Yeah, and tax planning is not just a one-time event, it's year-round sport here. So you're going to always want to not just do it at the end of the year where not as much could potentially be done to help you. You're going to want to constantly do it year-round, the beginning of the following year to assess your situation, to plan ahead based on your income sources and possible deductions, and see what opportunities are available to possibly take advantage and identify planning opportunities that will help you save money on taxes. As far as these strategies are concerned here, you have to look at this year as for the Roth conversion. With the markets down, stock and bond markets down most of this year, it is still a great opportunity. Take advantage of that. And if you wanted to, at the beginning of the following year as well, if markets are still down, could also continue the strategy as part of a 2-year or multi-year approach to converting more money in the IRA to the Roth IRA. And then as far as the charitable giving is concerned, it's important whenever you're doing tax planning and looking at supporting causes and maximizing philanthropic benefit and minimizing income taxes, make sure that these charitable donations are given to qualified 501c3 public charitable organizations. Just be mindful the IRA qualified charitable distributions can only be made to these 501c3 public charitable organizations. They cannot be made to donor advised funds, private foundations, and support organizations. So check before gifting to ensure the organization is qualified to accept charitable donations.
Great. Well, Philip, as always, I want to thank you for sharing your knowledge and wisdom with our readers and viewers. It's so greatly appreciated. Thank you.
My pleasure, Bob. Thank you again for having me on your show here.